Hey folks, we got a jumbo weekend edition video today. You're not going to want to miss. We got a lot to cover. I'm going to talk about positioning for my brokerage account, all the companies that I'm buying and why I'm buying them. I'm going to rank them, and then I'm going to talk macro. I'm going to give my outlook for the rest of the year, exactly what I think is going to happen in the stock market for the rest of the year and more. So you're not going to miss it, folks. Thanks so much for being here with us. Let's jump right in. Net worth right now is 1.4 million. As you know, I'm on the journey to get to financial independence. My goal is for 2 million. And right now I'm very focused on my brokerage account. As you can see, my taxable brokerage on the screen is about 53,000, 3.8% of the overall net worth. And that is what I really need to focus on, building that up. So my next goal is 100,000 by the end of the year. And so that is where I'm going to go into right now in a lot of details. But before I do that, I just want to thank you all for being here. We're up to 12 subscribers. We've had the channel for a week now, and just want to say thanks to you all for sticking with us and joining, and appreciate all your support. So thank you. So first things first, how am I building up this brokerage to hit that $2 million net worth? Well, the way that I'm doing it is every single week I am buying. So I wanted to show you the breakdown of the companies I'm going to be buying this week. I'm going to be buying the Mag 7 plus SpaceX, Broadcom, and then some Bitcoin. And here's the positioning. I'm also going to be buying every week. And this week, I'm going to be buying SCHD. I'm going to be buying small cap value and VMY. And I want to get the dividend ETFs going. So these are some of my bigger positions. And then the biggest position is in my growth and overall core with the S&P 500. So QQQ for the growth and SCHG for growth. And then right at the core is the SPY. So that's going to be $300 a week, every single week. I might bump that up more. I'm looking for ways to put as much as possible and to build up this brokerage account. And then from there, we're building up a quality dividend growth allocation to this particular account. And so here are the highest conviction growth dividend companies: Caterpillar, JP Morgan, Texas Instruments, Costco, Visa, Cisco, Eli Lilly, MasterCard, Waste Management, and S&P Global. So we're buying this each and every week. And then every single month, we're buying our lower, more value dividend companies, the ones that have some higher yield. And so we're going to look at those in detail in just a second as well. And then our second tier dividend growth companies as well. So this is a new addition. I am experimenting with this over the next couple of weeks. I'm not completely sold on it, but I'm thinking of ways that I can build up income, so where I can buy more positions within the account and reinvesting dividends. And so I'm looking at some high dividend yield ETFs. This is outside of the scope of my normal investing style, but I'm going to be doing some experimental, some low risk and testing out how this works and how it fits in the portfolio with some of these high yield dividend ETFs. So first things first, as promised, I'm going to go into the details of the companies and why I own them. I'm going to talk about bull case and risk. So NVIDIA is the number one company in the portfolio in my estimation. It has the best fundamental growth engine. The current P is 29 times earnings, market cap about 4.7 trillion. And the revenue for Q1 2027 is looking to be, it's reported, that was 2026, typo, 81 billion, up 85% year over year, and a gross margin of around 74.9%. Hard to argue with those numbers. Bull case is obviously AI, GPUs, networking, and robotics. And then the risk, though, is any sort of AI CapEx bubble that we see, hyperscaler slowdown, which I don't really see that happening, or potentially issues with China. So still the highest quality growth stock in the Mag 7. NVIDIA, I'm giving it a 10 out of 10. Revenue 65% year over year. The forward PE of 21 times earnings. We have a big moat, the AI ecosystem. Then overall verdict is great, reasonable growth valuation. Not a huge bargain right now, but not as expensive as it was a year ago. NVIDIA is the number one company. I'm not going to spend as much time on all the companies, but I'm giving NVIDIA the top place. Google is about a 9.8, right behind NVIDIA. Obviously, revenue is 400 billion year over year, 14%. PE 26 times earnings. We have the moat for search, YouTube, all the things, and it is a big disruptor. I think the biggest risk is for one of the reasons why it pulled back over the last few months is because, AI being able to do the search function that Google's once known for, but still a great value in the Mag 7. Meta, this is a cash machine, operating margin 41%, Ford P 22 times earnings. It has Instagram, obviously Facebook, WhatsApp app. It's just a cash machine for advertisement, cash flow, strong AI upside. Same risk though with all of the AI companies is AI capex regulation, and that's coming in number 3. Number 4, Microsoft. Really great deals out there on Microsoft. 35 times earnings. It is up, for revenue 15% plus year over year. I think it's still a great buy. I think that the biggest thing that you're going to get with Microsoft is the cloud, and then of course the Microsoft Suite Office. Amazon, I think Amazon is sort of a sleeper here. The runway for Amazon is massive. I think that Amazon, between Nvidia and Amazon and Google and Meta, these are all excellent companies to own over the next decade. Amazon Web Services is a long-term growth engine. It has like 4 companies in it. Within it, you've got Prime, you've got logistics, robotics. Amazon is big, and it's going to continue. It's a behemoth. It's going to continue to be one of the greatest companies in the world for the foreseeable future. Then we have Apple. The only thing about Apple is, I think, it's still a cash flowing machine. It still has a massive brand in the world, elite business. But I think the iPhone growth is going to slow. And then with the inflation that we're seeing on chips, it's having to cause the prices to, go up. And so don't give Apple quite as high as a score, but still bullish on Apple. Gross margin 47%. Tesla, same story. I think Tesla's still a great company. The only thing is the valuation is a little bit stretched, and it really depends on the future for Robotaxi and Optimus. More to come on this one. I think that it's a little bit expensive, but I still keep it in the portfolio, mainly because it's hard to bet against Elon. I think one of the big bull cases, potential upside that no one's talking about, is if Tesla and SpaceX join together as one company. I think that would highly benefit Tesla's share price. So overall ranking between those would be in Nvidia, very close with Alphabet and Meta and Microsoft. I actually wanted to put Amazon a little bit higher, and I probably would still do that. And we'll see how things play out though over the next few quarters with Amazon's earnings. Next up, we have Broadcom. Broadcom is a company that I hadn't had in my portfolio in a huge position until recently. I've started adding to it significantly, and that is because the AI revenue growth, 106% year over year. It's just unbelievable the growth that this company has seen because of the super cycle wave with AI. So I would give this about a 9.9. Palantir, I still think it's a very expensive valuation, but I think we're going to continue to see it grow. 104% year over year growth first quarter of 2026. And I think that, this is going to be one of the great AI companies in the world in the foreseeable future. SpaceX, I'm a very big believer in SpaceX. The valuation right now is extremely expensive, but I do think that as the long play, I look at this as not a 1 or 2 year or 3 year hold. I look at this as a decade or even a multi-decade hold for basically the monopoly they have in space and rockets. And I think that they're going to dominate that whole market, and it's going to be a $10-20 trillion market for space for rockets. So I would give this a 10 out of 10 with the long-term hold. Nvidia, SpaceX, Broadcom, Alphabet, Meta, Microsoft, Amazon, these are all great companies to hold. I would put those as S tier, and then A tier, I'd put it Palantir, Apple, and Tesla. So moving along to Bitcoin, what about Bitcoin? I also hold a small position in Bitcoin, and I do think that Bitcoin is, in terms of crypto, it's the only one that I hold. I have a little bit of Ethereum, but I have the highest conviction in Bitcoin, the highest quality digital asset in the world, and it's my favorite long-term hold for cryptocurrency. I'd give it a 9.8 out of 10. It has a market cap of 2.5 trillion. I think that it's going to continue to be around the long term after the next halving cycle, where I think, it's going to, we could see a huge price jump. Obviously, we're down right now, but the only downside risk is volatility and regulatory uncertainty. But I think long-term Bitcoin is going to do really well. Taiwan Semiconductor is another one that I hadn't been a huge holder of because of the Taiwan-China geopolitical risk. But I think that this, as the world's leading advanced chip manufacturer, I think that this is a company that I'm going to continue to be buying in every single week. And it's just hard to argue against with the AI supercycle wave and this being the most important semiconductor manufacturer in the world. ASML is got a monopoly on the EUV lithography machines. Anytime you have a monopoly, it's very, it's very helpful for revenue and profits and things of that nature. All the fundamentals look very sound on this company. I started buying this company earlier this year, and I think it's going to do really well in the foreseeable future, and I would consider it part of the AI investment. Visa is one of the greatest credit card companies in the world. It's sort of had a duopoly with MasterCard over the last 2 decades. I think it'll continue to do well even if there is disruption in that space. Until we see a change in fundamentals, continue to buy Visa. I'd give it a 10 out of 10, and it's going to be very difficult to replace it. It's going to happen incrementally and not overnight. Costco, huge brand, the membership renewal. People love Costco. It's just unbelievable loyalty in terms of customers pay to shop and keep coming back, consistent sales and earnings growth. The membership renewal is plus 90%. People love Costco, and it's just a huge cash cow. So going to be buying Costco as one of the highest convictions. Recently adding S&P Global. This company was not on my radar for dividend growth, but as it continues to do well quarter after quarter, it's a little bit expensive right now, but banks and investors are relying on it for financial data, and the revenue of $15 billion, operating margin of 49%. It's definitely sort of the toll booth on the global financial markets. So going to be adding this in a small position in the portfolio every single week. Eli Lilly, also a new one that we're adding to the portfolio. Revenue growth of plus 30%. It's a little bit expensive, but overall, it's got a massive global growth opportunity, particularly with treatments for diabetes and obesity. Great healthcare company. MasterCard, just like Visa, not a whole lot different here. Just a wonderful credit card payment business. It's world-class. It's a huge compounder. It's going to continue to grow, and there's not a lot to say negative about MasterCard. JP Morgan, it is the strongest bank in America. It's most diversified. It's probably the best bank in the world, arguably. It's really cheap on earnings right now. It's got a decent dividend, and it's definitely going to be I would put it as A tier in the portfolio. Waste Management is got a little bit of a boring business, but it's huge in compounding, valuable landfills, big moat. It's got reliable cash flow, great dividend growth company. Texas Instruments, it's done analog chips for decades, long history of dividend growth, and it's one of the highest ranking chip companies in the world. Caterpillar has benefited greatly from the AI investment. It was kind of a sleeper, but it's obviously the king of heavy equipment with the infrastructure build out, with all of the construction that's going to go on for the next 5 years, 10 years for building data centers and AI manufacturing. It's hard to argue against. It's a global leader in the construction. So Caterpillar, I would put as a A-tier company in the portfolio. Cisco, I would also put as A-tier because it's just a powerhouse for networking, switches, and all the things that are tied to the infrastructure build out for AI. It's also got a nice growing dividend, huge cash flow. And so I would put this as A-tier. We already talked about Taiwan Semiconductor. We mentioned ASML. Applied Materials is another one that benefits. It's picks and shovels for the AI boom. It makes the equipment used to build chips, so it's got to be in the portfolio as A tier. Then we have Micron. They've benefited massively from the AI build as well. We've got DRAM and the 4 PE at 12x. I think this is one that maybe the valuation's a little stretched, but it's one of the biggest memory winners in the whole AI boom, and it's going to continue to do well over the long term. And not to mention, this company's been around for decades. AMD, same story. It competes with NVIDIA and Intel on CPUs, but it's actually having a great run here with everyone that's been involved in AI. So it's got to be a part of the portfolio is A tier. Marvell, same thing. I mean, it's not to be a broken record, but AI is going to be the future for technology. And so Marvell, it builds the AI networking and custom AI chips. It's got to be a part of the portfolio is A tier. B tier would be Intel. I hesitantly have been putting this in the portfolio. I may remove it and sell, mostly because of just this momentum we've had with AI, and because Trump mentioned it. And sometimes when Trump mentions company, they grow 100%, 200% in 3 months. So it might be a turnaround, but it's hard to tell at this point. It is somewhat of a competitor, with, for example, Taiwan Semiconductor, but it is it's a decent company. I'd put it at B tier. Now we have in other companies for our growth dividend portfolio, Home Depot. The housing market's been hammered, but with hurricane season coming around soon at the end of the summer, I think Home Depot could get a bump. Coca-Cola, it doesn't just own sodas, it owns a ton of different brands, so it's hard not to put it into the growth dividend portfolio. Also, same thing with PepsiCo owning Gatorade and Doritos and Lay's and all of this. It's hard to argue against as a great consumer staple company. McDonald's has 40,000 restaurants worldwide, just a global franchise powerhouse. It's basically resilient, and it's just a good growth dividend company. I would put these as A tier or B tier. Philip Morris, this is just, another cash flowing dividend machine. It doesn't grow significantly, but it's got a really strong dividend. Same thing with IBM. It's got a big dividend. It's also benefiting from the AI and cloud businesses. So I think it's worth having in the portfolio as B tier. Starbucks and Realty, I would also put as B tier. Starbucks obviously is the world's largest coffee chain, and I think that its growth is probably slowing down, but it is nice to have for dividends. Realty Income owns a ton of rental properties. It's kind of a powerhouse in that whole market. It's one of the best quality REITs out there. And then Altera, it's similar to Philip Morris in terms of the company, but the dividend yield is hard to argue with at 7%. Verizon and AT&T are good companies also to have in the portfolio for growth dividend. It's more of just a dividend payer than a grower, but it's still steady cash flow. And then American Express, I would actually put it A tier, whereas, Altera, Verizon, Starbucks, and Realty, I would put it B tier. American Express is definitely a strong company, just like Visa and MasterCard. It's a premium credit card. It's really more of the wealthier consumer base, and it's just a premier compounder. Walmart, I would put it A tier. It's the world's largest retailer. It's growing in advertising and e-commerce. It's just a powerhouse business. It's hard to argue against having Walmart in the portfolio. United Healthcare, along with Eli Lilly, are the best healthcare companies, arguably, for growth dividend. This is the largest U.S. healthcare company in the world, and so it's just a giant. And when you can get it on discount at 15x, I think it's a little bit expensive, a little more expensive than that now, but it's definitely a company I want to have in the portfolio. NextEra Energy, I don't buy a ton of utilities because they're regulated, and so with a regulated utility, you can't grow as quickly. But I think with the AI build out, this being the best utility company, it's one to have in the portfolio. In terms of all the sectors out there, I know the most about the utility sector because I actually worked in it for a decade. But ultimately, at the end of the day, utility companies just aren't big growth companies. They do usually pay a dividend, but because of all the regulation, it's very difficult to put a lot of them into the portfolio. Except for NextEra, it continues to do well with dividend growth and pay out consistently. Union Pacific is a great company to have as a dividend payer. It's the largest Western U.S. railroad. I would put this as A tier. AbbVie, I would also put this as A tier for, just a drug pharmaceutical company. And then Air Products, APD, I would also put this as A tier for industrial gases worldwide. So here's my S tier companies: the elite compounders, NVIDIA, Microsoft, Visa, Amazon, Broadcom, Taiwan Semiconductor, Costco, Google, Meta, ASML, S&P Global, Apple, MasterCard, Eli Lilly, Home Depot, JP Morgan Chase, Micron, Applied Materials, Texas Instruments, Union Pacific. I changed my mind on Apple and Home Depot, and then everything below that I would actually put at A tier. Here's some other A tier companies: Waste Management, Coca-Cola, Pepsi. Everything on here I would keep as A tier except for Philip Morris and arguably the energy companies, Exxon and Chevron, as well as some of the the precious metals. I would put those more as B tier. These are just some other ETFs and positions that I have. I'm calling them A tier right now. The India one is a little more high risk. It hadn't done that well over the last couple of years of owning it, but India is supposed to be a very big growing economy. So that's how I would rank those. The only ones in the portfolio that I think could be potentially, if you wanted to play devil's advocate, Tesla and SpaceX, since the valuations are much dependent upon future, like long-term future, you could argue that those could be C tier. The same thing with any of the ETFs that are the high dividend yield ETFs. It remains to be seen on whether those will be good investments, in my opinion. They're not going to be growers, obviously, but in terms of the pricing decay, I'm not sure how those will hold up in a very volatile market. So I can't really say if I could put those above C tier. These are just, showing more of the positions that the buyings that are going to happen every single week, bi-weekly, and SCHD. Those are the high yield ETFs. These are the energy companies. Here's some of the growth dividend companies. And here is the international for diversification and precious metals with a little bit of bonds. And so that is what we're doing right now. So in terms of international rankings, some of the ETFs, I think this Vanguard fund is the all-in-one international ETF is the best. It's got a super low expense ratio. The India one, I'm not super excited about, but I do want to have exposure to India. This REIT ETF with Vanguard, I think, is really great. And then SCHF, I'm trying out. I'm adding it to the portfolio to see how well it does. It might not be as good as the Vanguard one, but I am interested to see because it does have a low expense ratio. Emerging markets just have to have it for long-term growth. This Pacific in the Latin American ETFs, I would put those more as B tier, but I do want to have some specific exposure to the Pacific markets as well as Latin America. I did talk about this yesterday, that in July the market does tend to rip up on seasonality. So I think that we could see a very bullish July. I'm anticipating that markets are actually going to do really well this July. I wouldn't be surprised, and so I'm setting my base case as a plus 2% on the S&P 500 and a plus 3% on the NASDAQ. And I think that we could see potentially in a bear case, I think that we could see just like minus 1 or 2%. I don't expect a huge crash or anything like that in the month of July. So switching over to sort of macro and my market outlook for the rest of the year, I love talking about this in terms of monetary policy, fiscal policy, geopolitics, and I want to explain to you how I'm seeing things right now for the next 2 quarters. Obviously can't predict the future, but based off of everything that I'm seeing, the first and most important thing to mention is the Federal Reserve, and that's because it has to do with the power that it has. It is in its ability to change markets. And what I would say about the Federal Reserve is that since inflation has moderated substantially from the peak a few years ago, we do still want to keep an eye on it, though. And because of government spending, wage growth, persistent service inflation, I would look at the Federal Reserve as, I think they're viewing everything in a cautious manner. We have a new Fed chair, so I don't think there's going to be any drastic moves right off the bat. But I think that over the next few quarters, I think that we could see some talks of rate cuts. I know that there's more talk and more higher percentage of rate hikes because of the inflationary situation that came from the Middle East, because of the increase in gas. But I think that that's mostly contained. And what I would expect is that I would expect earning multiples to expand, growth stocks to outperform, and then small caps and mid caps to continue to do well. I think inflation, it's possible that rate cuts are delayed, that bond yields rise, and I believe the most likely outcome is there's going to be, I'm more dovish than I am hawkish, and I don't think there's going to be any big moves. I don't think there's going to be any 0.5% moves that are going to spook the market. And so for the next 2 quarters, I think that what we'll see is actually either neutral to dovish positioning from the Fed, which markets will I don't think have fully priced in yet. I think the markets are anticipating a neutral to hawkish, but I think that that's actually not going to come to pass. The other thing is national debt. The debt is a structural problem because it's increasing significantly. But I think with the thing that's happening right now, I don't think it's going to cause any sort of immediate crisis. But I do think that it will actually be dealt with through inflation. I think it will be dealt with the increasing of the economy, and owning assets like Bitcoin, I think, is important to protect against the sort of fiat problems with national debt. So national debt is more of a long-term concern than it is a short-term thing. And I'm not too concerned about it at this point. Geopolitical issues in Iran, obviously this has been problematic and caused a lot of volatility in the market with oil. Now that oil has turned the corner and it's come down, I don't think that there's going to be that much in terms of, consequences from that in terms of inflation. I think that the Fed is looking at this, and I'm basically, not too concerned about it. I'll put it like this: the market has baked in basically this entire situation, and the sort of back and forth of attacks, peace, rug pull. This is just going to go back and forth for a little while. But I think since that the market's baked it in, and the oil prices are essentially going to normalize, I don't think this is too much of a concern. Midterm elections is a pretty interesting one because political uncertainty, it can cause volatility in the market, but it's always short term. And so there's going to be uncertainty going up into the election in the market, and it will cause more volatility. But once the midterms are over, markets are going to continue to do well, in my opinion. So I'm basically bullish on equities post midterms. In terms of the assets, breaking down between like stocks, Bitcoin, and so on, my base case is basically the AI investment is going to continue in its cycle. It's not over yet. Earnings cycle is going to continue to grow. We're not seeing a ton of weakness in earnings yet. And so quality growth companies like the ones that I've mentioned are, going to be how I position my portfolio. And then we'll see how things look by the end of the year. Bitcoin is on sale right now, as far as I can tell. It's very attractive from a scarcity perspective for the long term. There's always going to be volatility. There's always going to be pullbacks. And I think that as we continue to see institutional adoption, Bitcoin will do well in the long term. Right now, it's got a lot of negative press, but every single halving cycle, when it pulls back, there's always negative press, and people are always going to be bearish toward Bitcoin, but ultimately, Bitcoin's going to be around for the long term. Bonds, I don't really think there's really a great need to have bonds in the portfolio for me at this point, except for short duration ones for the just a little bit of income in cash. But it is important to note that the bond market does give us signals, some smoke signals on what's coming. And so in a future video, we'll probably look at like some of the yield curves, the 2 to 10, and what they tell us about, recession and things of that nature. Precious metals, gold continues serving as the monetary hedge. Silver and platinum would benefit if global manufacturing accelerates. I believe precious metals are basically insurance. They're not a growth engine. Very small percentage, like 1%. So current positioning at the large is the core S&P 500 index fund, large cap growth with a tilt towards semis. And then we have the Magnificent Seven for growth. And we talked about Bitcoin and space as part of the growth engine. For income, we have the dividend growth stocks in the portfolio, SEHD, and other high-quality dividend ETFs. And then more recently, adding a very small position in the high-yield dividend ETFs for income to reinvest into the portfolio. Diversifiers, international equities, energy, precious metals, the short duration treasuries, and then the REITs. Bottom line, the next 2 quarters, they're going to be volatile, more so than the first part of the year, but I don't think that the bull run is over. I think we're going to keep going up from here. I think we're going to have a great July and periodic corrections and pullbacks, and then we're going to continue to see the AI build out and markets are going to eventually align with earnings and fundamentals. Right now, there's a lot of sort of elasticity and surprises that we've seen, especially with the Mag 7 getting beaten up. And there's a lot of movement around the markets with, rotation that's taking place. Steady accumulation with, the long-term view in mind is my strategy. Dollar cost averaging, broad diversification, keeping cash on the sidelines for pullbacks, owning businesses with durable competitive advantages, and holding exposure to energy, international markets, Bitcoin, and precious metals for its long-term diversifiers, ignoring the short-term noise and focusing on compounding over the next decade. That's how I'm going to build up the brokerage account. Lastly, an additional outlook for labor market and black swan risk. Definitely have to pay attention to what the labor market does. It is cooling but not breaking. Unemployment rate is 4.3%. It stayed in a narrow 4.3, 4.5 range since July of 2025. Another indicator of markets and the economic outlook that I didn't mention is real estate. Usually the real estate market is when the labor market is strong, real estate is strong, and they're basically, they align. And right now the real estate market is weak. Houses are generally unaffordable, which can speak to the labor market as well. So if jobs stay stable, if unemployment stays under 4.5, then the Fed will, kind of have a soft landing and cut slower. Stocks will continue to, have momentum and go higher. Whereas if unemployment rises above 5% or toward 5%, and, there's a lot of uncertainty about the labor market, then we could see sort of a cyclical weakening in equities, and there would be an increased volatility that could lead to a broader correction. If unemployment goes even higher than that, then there's definitely increased probability of wide sell-off. The Fed might need to do more aggressive tactics in cutting rates. I would say that this is somewhat unlikely but plausible. And then you always have the black swan risk, the unpredictable things. If we are in an AI bubble, it could pop. Cyber attacks, this sort of political election instability that could impact markets more than people expected. The Middle East war widening and things of this nature, credit risks in banks. These are just issues that can cause black swan risks. So in terms of the portfolio, I'm not all growth. We have the core, we have cash, we have inflation hedge with energy, we have hard assets, and then global exposure, and then a scarcity asset of Bitcoin. So we try to stay basically diversified, but we're tilted towards semis, AI, and growth, and we're bullish for equities right now. And so my base case is no severe recession, sort of no fear and gloom and doom, but a gradual easing actually is what I predict over the next, I would say over the next 2 quarters. We'll learn more about that easing, and then we'll see it in 2027, and then continued leadership. We're going to continue to see growth in the whole AI super cycle build out. The biggest issue, though, is the labor market. If employment holds, I'm going to stay aggressively invested. If it weakens, then may need to look at pullbacks. And the goal isn't really to predict anything. It's just to build a portfolio that can survive during the unpredictable. So that's all for today, folks. Thanks for sticking along with me in this journey, the road to 2 million in the portfolio, building up the brokerage. Next goal for the brokerage is from 50,000 to 100,000, investing heavily every single week. And this is how we're doing it. And this is how I'm thinking about it from a macro perspective, from a fundamental perspective, and appreciate you all being here. If you have any comments or thoughts, leave them leave me a comment. And if you like this video, all I ask is just hit the like. And if you want to follow along with us, glad to have you here, a part of what's happening. So thanks so much.